Welcome back to the deep dive. Today is Wednesday, January 28, 2026. And I have to say, if you have been watching the ticker tape today, your eyes might be hurting a little bit. It is bright green out there.
It is a sea of green. One of those days where the market decides to take a deep breath and just, jump in with both feet.
We are talking about the big one today. The company everyone loves to hate, but let's be honest, everyone uses. Meta Platforms.
The big one. Yeah.
They just dropped their Q4 2025 earnings. And look, I remember 2023. I remember 2024. I remember Mark Zuckerberg wearing the hoodie, or was it the T-shirt by then, and talking about the year of efficiency.
Oh, I remember it well. The year of efficiency. It was the mantra.
Cut the fat, get lean, make the investors happy, stock goes up. It worked.
He was a very effective narrative. Wall Street loves a diet plan. They love seeing a company trim down and focus on the bottom line.
Exactly. But I'm looking at this report we have today, this massive stack of data, the 5-part framework from stockanalytics.ai, and I am not seeing a diet plan. I am seeing an all-you-can-eat buffet of spending.
That is a very polite way of putting it. I'd say they've pushed away from the salad bar and are now parked in front of the dessert table with a shovel.
So my first question to you before we even get to the slides is the year of efficiency dead?
Oh, it's not just dead. It's buried. And they built a $10 billion data center on top of the grave.
Wow, okay. So no ambiguity there.
None. We are firmly in a new era. If 2024 was about efficiency, 2026 is about superintelligence. And superintelligence, as it turns out, is incredibly, incredibly expensive.
That sets the stage perfectly. So here is the mission for this deep dive. We have the press release, we've got the Jeep numbers, the analyst notes, the sentiment reports.
The whole stack.
The whole stack. And we are going to figure out how a company can make more money than it ever has in its entire history, and yet somehow leave people like me worried about its spending habits.
It's the core conflict of the episode, isn't it? It's this paradox. The cash register is ringing off the hook, but the construction crew out back is spending the cash faster than the cashier can count it.
We're going to find out if that's a disaster or a masterstroke. And I want to flag something for you, our listeners, right now. Stick around for slide 3.
Oh, yeah.
There's a number in there, a profit paradox involving Instagram and Facebook, that I honestly thought was a typo when I first read it.
I did too. I had to double-check the source filing.
It completely changes how you should view the app on your phone.
It's the aha moment of the entire quarter. I'd say it explains the future of the internet in one single statistic. It's that important.
All right, let's stop teasing and start analyzing. Let's pull up the first board. Slide 1, the at-a-glance scorecard.
So the scorecard, this is where we look at the headline numbers. And in the world of high-frequency trading and algorithmic movements, the raw number, the billions, doesn't matter as much as the delta.
The delta being the difference between what everyone thought would happen and what actually did happen. The expectation versus the reality.
Precisely. It's all about that gap. If you expect an A+ and you get an A, the stock crashes. If you expect a C and you get a B, the stock soars. It's all relative to that consensus number.
So what's the verdict? A, B, C?
It is a definitive, undeniable beat. A solid A, maybe even an A+ way.
Okay, lay the revenue on me. What's the top line number?
For the fourth quarter of 2025, Meta reported revenue of $59.89 billion.
59.89, so just a hair under $60 billion.
Just shy.
In 3 months.
In 90 days. If you break that down, it's roughly $665 million a day, every single day. Christmas, New Year's, doesn't matter.
That is it's an absurd number to even comprehend. But was it what people expected? What was the delta?
No, it was better. The consensus estimate from the street was sitting at around $58.59 billion. So they came in about $1.3 billion higher.
A $1.3 billion beat.
Yeah, that is a beat of roughly 2.2%.
I mean, in most industries, finding an extra $1 billion is a decade-long strategic goal.
It's the entire annual revenue of a very successful company.
And Meta just sort of found it in the couch cushions during the holiday rush. What does that tell us about the economy? Because usually if the ad market is weak, it means a recession is just around the corner.
It tells us the consumer is alive and well. You don't get a beat like that unless retailers are opening up their wallets and spending heavily on ads to move product during the holidays. It proves that the digital ad market, specifically the direct response stuff where you click an ad and buy a shirt immediately, is absolutely thriving.
Gangbusters was the word I saw in one of the analyst notes.
It's an appropriate word. And it's not just the beat. Look at the growth rate. That $60 billion number isn't flat. It's up 24% year over year.
24%. For a company this size, that feels like it should be physically impossible. Usually when you get this big, gravity kicks in, you slow down to like 5% or 8% growth.
Exactly. That's the law of large numbers. It's supposed to be an unbreakable law of business physics.
But Meta seems to be defying gravity right now.
They do. To grow a nearly $250 billion annual run rate business at 24% is startling. It just speaks to the pricing power they have and the relentless effectiveness of their ad engine.
Okay, so they sold a lot of ads. They brought in a mountain of cash. But did they keep the money? Let's talk earnings per share, the bottom line.
A bottom line, this is what you, as a shareholder, actually own of the profit at the end of the day. Meta reported a diluted EPS of $8.88.
Lucky number 8.
Indeed. And the consensus was only $8.21.
So they beat profit expectations by 67 cents per share. What's the percentage on that?
That's a huge beat. It's about 8.2%.
An 8.2% earnings beat. That's a massive gap. So the revenue beat flowed all the way down to the profit.
It did. And that is exactly why the stock popped, 3-4% in the after-hours session. The market was terrified that the spending, which we are definitely going to get to, would eat all the profit.
Right, that was the big fear.
The big fear. Instead, the revenue was so strong, it covered the spending, and then some. Investors just breathed a collective sigh of relief.
Now, hold on. I want to sidebar here for a second because this is important. You use the phrase diluted EPS, and I see on the report there is another number, basic EPS, which is actually higher. It's $9.02.
Correct.
Why are there two different numbers? And why are we using the lower one? Are we just being pessimistic here?
It's a great question, and it's a critical distinction that trips up a lot of retail investors.
Hmm.
No, we aren't being pessimistic. We are being realistic. It comes down to a concept called dilution.
Dilution. Okay, like watering down a drink.
That's the perfect analogy. Let's imagine Meta's profit, all those billions, is a giant pitcher of lemonade.
Okay, I'm thirsty. Go on.
Basic EPS calculates your share of the lemonade based on the people currently standing in the room holding a cup. That's the current share count, about 2,525 million shares. So profit divided by that number.
Okay, simple enough.
But waiting just outside the door, there's a long line of Meta employees, thousands of them, and they are holding these little tickets called stock options or restricted stock units, RSUs.
I've heard of those.
Those are promises from the company that say, one day you can turn this piece of paper into a cup and come get some lemonade.
So they aren't shareholders yet, but they have a ticket to become one whenever they want.
Exactly. Diluted EPS is the scenario where we open the door and let everyone in. We assume every single employee exercises their options and converts them to stock. Suddenly, instead of 2,525 million shares, we have 2,565 million shares.
So the denominator in the equation gets bigger.
Correct. The pitcher of lemonade is the same size, but now there are more cups, so everyone gets a slightly smaller sip. That is why diluted EPS at $8.88 is lower than basic EPS at $9.02.
That makes perfect sense. So if I'm looking at a stock on my phone or in my brokerage account, I should always be looking at the diluted number.
Always. It's the most conservative and therefore the most honest way to value your claim on the company's cash flows. Assume the dilution will happen, because it almost always does.
Got it. Okay, back to the scorecard. There was one line item on here that made me stop cold. It's about buybacks.
Ah, yes. The silent alarm bell on the report.
The report says share buybacks in Q4 were nil, 0, a big fat goose egg.
Correct. Not a single share was repurchased in the fourth quarter.
But wait a minute. For the full year of 2025, they bought back $28 billion of stock. They were buying hand over fist in Q1, Q2, Q3. I remember the headlines.
They were vacuum cleaner for their own stock.
And then Q4 comes along.
Right,
The vacuum cleaner is unplugged. Complete stop. Why? What does that signal?
This is the most significant strategic signal in the entire report, in my opinion. It's more important than the revenue beat.
Really?
Yes. Because when a company buys back stock, they are sending a message. They are saying, we have excess cash, we don't have a better internal use for it, so we're returning it to shareholders to boost the stock price.
Oh, right. It's a thank you gift to investors, a reward for their loyalty.
Exactly. But by stopping cold in Q4, management is screaming a different message from the rooftops. They're screaming, "We need the cash."
Need the cash for what? They made $60 billion in revenue? They're swimming in
For
cash.
the infrastructure build-out, they are hoarding liquidity. They looked at their projection for 2026, the server farms, the GPUs from NVIDIA, the custom chips they're designing, maybe even the power plants they might have to build to run it all, and they realized something.
Boy.
They realized, we cannot afford to give this cash back to investors. We need every single penny to buy silicon and pour concrete.
That is bold. It's a
Wow.
huge change in capital allocation policy.
It is a pivot. They've shifted from returning cash mode to war chest mode.
So if I'm an investor who is counting on those buybacks to keep the stock price floating up, as a bit of a safety net, that safety net is gone.
It's gone. You are no longer investing in a cash return story. You are investing in a venture capital story.
A venture capital story inside a $2 trillion company.
That's it. You have to trust that Mark Zuckerberg is going to turn that hoarded cash into something worth 10 times as much in the future. The immediate reward is gone, replaced by a promise of a much bigger but much riskier future reward.
Which, knowing his track record with things like Instagram, is possible, but it's definitely a different risk profile.
A much, much higher risk profile.
Okay, so the top line is great, but they are hoarding cash like doomsday preppers. Let's look at why. Let's look under the hood at the engine. Slide 2, the engine of profitability.
Now we have to move from the sales numbers to the efficiency numbers. We need to see how much it costs to run this machine, to generate that $60 billion in revenue.
And this is where the whole year of efficiency narrative really falls apart, isn't it? I want to talk about a concept called operating leverage. Usually with software companies, I'm used to hearing about positive operating leverage.
Right. That is the holy grail of software. It's what makes the business model so beautiful.
Explain that for the listener who isn't an accountant. In a perfect world, what should operating leverage look like for a company like Meta?
Think about Microsoft or Adobe. Once you write the code for Windows or for Photoshop, it costs you almost nothing to sell a copy to the next person. You just copy-paste the bits.
Right. It's infinitely scalable.
Exactly. So if your revenue goes up 20%, your costs might only go up 2%. The difference, that 18% gap, goes straight to profit. Your profit margins expand. That is positive operating leverage.
Okay. So in simple terms, revenue grows faster than costs.
Much faster.
But that is not what happened to Meta in Q4, is it?
No, not at all. Meta experienced distinct and, frankly, quite alarming negative operating leverage.
Give me the ugly numbers. How bad was it?
Revenue grew 24%. We established that, and that's great. But costs and expenses, they grew by 40%.
40%.
40%.
So for every extra dollar they brought in, they spent. I mean, the growth in spending was almost double the growth in sales.
That's it. The growth of the spending is lapping the growth of the sales. And that just crushes your margins.
Let me put it in perspective. In Q4 2024, Meta's operating margin was 48%.
Which is elite. That is best in the world territory for a company of that size.
Absolutely elite. And now, in Q4 2025, it dropped to 41%.
They lost 7 full percentage points of margin in a single year.
That is billions of dollars of profit that simply evaporated into expenses. They made a conscious choice to trade those 7 points of margin to fund this AI transition. The savings from the year of efficiency have been spent, and then some.
I feel like we need to understand where a company spends 40% more money in a single year. It's not like they opened 5,000 new retail stores. They're a digital company. Where did the money go? The report breaks it down into buckets. And the story is in the buckets. Let's look at the first one. Marketing and sales.
Okay. This is the budget for advertising Facebook on other platforms, paying salespeople, etc.
Correct. This bucket only grew 5%.
Wait a minute. Revenue up 24%, but the cost to get that revenue is only up 5%.
Yes.
That's actually incredibly impressive. That is positive leverage right there.
It is. It's the one bright spot of efficiency in the report. It means the product sells itself. They don't have to hire an army of salespeople to call advertisers. The automated tools work so well that advertisers just come and swipe their credit cards. That part of the business is hyper-efficient.
Okay, so the sales team isn't the problem. The advertising budget isn't the problem. Who is the problem?
The scientists are the problem. Or, depending on your perspective, the heroes. Look at research and development, R&D.
Oh, boy. I see the number here.
R&D spending spiked 48% year over year.
48%.
It went from $9.2 billion in Q4 of 24 to $13.7 billion in Q4 of 25 in chaff. 1. quarter.
They spent nearly $14 billion on research in 3 months.
Yes.
Just to put that in perspective, $14 billion is like the entire GDP of a country like the Bahamas. They spent an entire island nation's economy on coding and servers in 90 days.
Essentially, yes. And it's now consuming 23% of their total revenue. A quarter of every dollar that comes in the door goes right back out to R&D.
Is that normal? I feel like that's not normal for a mature company.
For a mature, profitable company, absolutely not. Apple spends maybe 6 or 7% of its revenue on R&D. Google is a bit higher, maybe 16%. 23% is what you see in a pre-revenue biotech startup that is trying to cure cancer.
So they're acting like a startup again.
For a company of Meta's size and profitability to be reinvesting a quarter of its revenue back into R&D is, quite frankly, a Manhattan Project level commitment. There's no other way to describe it.
A Manhattan Project for AI.
That is the only comparison that fits. This isn't just maintenance R&D. This isn't just tweaking the user interface. This is hiring the most expensive AI researchers in the world, people who command million-dollar-plus salaries. This is building custom silicon chips to try and replace NVIDIA. This is training Llama 4 and Llama 5 on clusters of computers that consume as much electricity as a small city.
And unlike a marketing budget, you can't just cut this next month if the economy turns sour or the stock goes down.
No way. These are multi-year roadmaps. You build the data center, you sign the power contract with the utility for a decade, you hire the PhDs, you are locked in. This is a fixed strategic commitment, not a variable cost you can just turn off.
Okay, so R&D is the big driver of the spending explosion, but I noticed another weird spike in the report, G&A, which stands for General and Administrative.
Ah, yes. The junk drawer of corporate accounting. Everything that doesn't fit elsewhere gets tossed in here.
It spiked 67% to $3.6 billion. 67%. Did they buy gold-plated desks for everyone? Did they replace the office coffee with liquid platinum? What is that?
Chuckles. I doubt it. When you see a G&A spike of that magnitude in a single quarter without a big merger or acquisition, it almost always means one thing.
What's that?
Lawyers.
That lawyer.
Or more specifically, legal settlements and fines. Meta has been in a decade-long brawl with the European Union over privacy, over the Digital Markets Act, over data usage. A 67% spike suggests they are accruing for a massive fine or settlement. They're putting money aside in this quarter to pay a penalty that's coming down the line.
So it's dead money. It's not an investment.
Completely dead money.
Yeah.
It produces no future value. It's just the cost of doing business as a tech giant in 2026.
Yeah.
A major drag on profit.
So let me get this straight. We have margins crashing from 48% to 41%. We have R&D exploding by almost 50%. We have legal bills piling up.
Yeah.
But going back to slide 1, we had a massive earnings per share beat of over 8%. How? If the business got so much more expensive to run, how did the profit per share go up so much? The math doesn't seem to work in my head.
It's a great observation. Because if you just look at operations, the beat shouldn't be this big. The savior of the quarter, the reason the headline number looks so good, came from a very boring place.
Yeah.
The tax department.
So you're kidding me. The accountant saved the day.
I am not.
Hmm?
Meta's effective tax rate for Q4 dropped to just 9%.
9%. I think I pay more than that.
Chuckles. Most people, and most companies do. Last year, in the same quarter, Meta had paid 13%. That drop from 13% down to 9% saved them hundreds of millions, if not billions of dollars.
Why did it drop? Did they move the headquarters to a volcano lair in international waters?
The report references a specific piece of legislation passed in Q3 2025. I actually had to look this up to make sure it was real because the name is so ridiculous. It's called the One Big Beautiful Bill Act.
Stop it. That is not the real name of a U.S. federal law.
According to the legislative citations in the Stock Analytics Framework, that is the official name, the One Big Beautiful Bill Act. Apparently, it included some very generous R&D tax credits and adjustments for repatriating intellectual property.
One big, beautiful bill. It sounds like something a cartoon character would write into law.
It does. But that cartoonish bill provided what's called a massive valuation allowance release. Essentially, the government gave them a huge tax break for spending so much on AI research and development here in the U.S.
So the government is basically subsidizing this AI arms race.
In a way, yes. And if that tax rate hadn't dropped from 13 to 9%,
The earnings beat would have been much, much smaller, maybe even a miss on the bottom line.
It would have been a squeaker at best.
Wow. So the headline beat that everyone's celebrating is partially an illusion. It's not just operational brilliance. It's a one-time accounting tailwind from a weirdly named law.
Exactly. The core business got harder and more expensive, but the tax bill got lighter, and that masked a lot of the underlying pain in the operating margins.
That is a crucial insight. Investors might be celebrating a tax loophole thinking it's sustainable business growth. Okay, let's peel the onion one layer deeper. Meta isn't just one big blob, it's two very different businesses glued together. Slide 3. The engine of business segment performance.
This is my favorite part of the analysis because this is where the truth really comes out. We get to separate the family of apps, FOA, from Reality Labs, RL.
Family of apps is the blue app, Facebook, it's Instagram, it's WhatsApp, Messenger, the stuff we are all addicted to.
The cash cow, the golden goose, the engine that powers everything else.
And Reality Labs is the metaverse, the Quest VR headsets, the avatars with no legs, the future bet.
The money pit, or the internal VC firm, as they like to call it. It's the speculative part of the company.
Let's look at the family of apps first. The cash cow. Revenue growth was incredible, up 25% year over year. They added something like $12 billion in sales just in this segment alone, right?
Yes. Just stop and think about that scale for a second. In one quarter, they added the equivalent of a Fortune 500 company's entire annual revenue, just in the growth of one of their divisions.
So ads are booming. The AI targeting is clearly working. Reels is printing money. It sounds like a victory lap for the core business.
It sounds like it. And if you stopped reading there, you'd think everything was perfect. But this is where we hit the great paradox I mentioned at the top of the show. This is the detail that should keep investors up at night.
I'm ready. Lay it on me.
Despite adding $12 billion in new revenue, the profit for the family of apps segment decreased by $2.4 billion.
Wait, pause. Say that again. They took in $12 billion more from customers.
Correct. $12 billion more in the cash register.
And they ended up with $2.4 billion less profit in the bank at the end of the day.
Correct. Year over year, profit for the core business declined.
How is that mathematically possible? Did they literally set the money on fire? It makes no sense.
Chunkles. In a digital sense, yes, they did. It is the AI tax.
The AI tax. Explain that concept.
We tend to think that all this insane AI spending, the data centers, the chips, the $13 billion in R&D, is for the futuristic Reality Labs stuff, for the metaverse. But it's not. Most of it is being spent to run Instagram and Facebook right now.
Why does Instagram need a supercomputer? It's just pictures of my friends' vacations and videos of cats.
Because the feed has fundamentally changed. 5 years ago, your feed was just photos your friends posted in chronological order. Retrieving a photo from a database costs Meta almost nothing. It's a tiny file. It's cheap.
Right, low compute cost.
Very low. Today, your feed is almost entirely AI-recommended high-definition video from people you don't even follow. Every single time you scroll a massive AI model, a recommendation engine has to run real-time inference. It has to look at a billion videos, predict which one you are most likely to watch for more than 3 seconds, and serve it to you instantly.
So every time I swipe up on Reels, a GPU somewhere in a data center in Oregon screams in agony.
Basically, that inference costs money. It costs a lot of electricity, it costs a lot of compute cycles, and the depreciation of those extremely expensive NVIDIA chips is allocated as a cost against the family of apps segment.
I get it. So the cost of goods sold, the cost to serve me my daily dose of digital addiction has skyrocketed.
Exactly. The cost of compute per user is rising faster than the ad revenue per user. Let that sink in.
That is a terrifying thought. It means their core business model, social media, is fundamentally changing from a high-margin, infinitely scalable software business into a high-cost, capital-intensive utility business.
That is the bear case right there. It used to be as cheap as sending a letter. Now it's becoming as expensive as running a power plant for every user. The AI tax is eating the margin of the cash cow before the money even gets out the door.
Wow. Okay, that explains the family of apps paradox. Now, briefly, let's touch on Reality Labs. I feel like we always just gloss over them because we know they lose money, it's expected, but is there anything new there?
There is, and it connects back to this AI story. Usually we just write this off as Zuck's hobby, a $5 billion a quarter loss, but we need to look at the intersection of AI and hardware.
You're talking about the Ray-Ban smart glasses?
The Ray-Ban Meta glasses. They're actually selling reasonably well, and they are a Trojan horse.
A Trojan horse for what?
Because for the first time, Reality Labs isn't just about escaping into a cartoon world with a big headset on. It's about putting a multimodal AI assistant on your face in the real world. The spending in Reality Labs is now heavily focused on miniaturizing this AI. They aren't just building VR headsets for gaming anymore. They are trying to build the physical interface for the superintelligence they are training in those expensive data centers.
So the $5 billion loss in Reality Labs this quarter.
Is the price of trying to invent and own the next iPhone, the next major computing platform. If they can make those glasses the must-have device for interacting with AI, that $5 billion quarterly loss becomes irrelevant. But if they can't,
It's just a bonfire of cash.
a very, very expensive bonfire.
Okay, so just to recap, margins are compressing, costs are exploding, the core business profit is shrinking, and buybacks are gone. Is Meta safe? I mean, are they going to run out of money doing this? Slide 4, financial strength and shareholder rewards.
This is the safety check. And the short answer is no. They are not going broke. Not even close.
Their balance sheet is still a fortress.
It's a citadel. They have tens of billions in cash and cash equivalents. They are generating massive cash flow from operations, even with all these higher costs. The machine still prints money, it just costs more to run the printer.
So they aren't borrowing money to fund this AI build-out. This isn't being funded with debt.
Not significantly, no.
Yeah.
That's the key. They are funding the Manhattan Project out of their own pocket. They are taking the profit from the family of apps and shoving it directly into the furnace of AI R&D.
But this brings us back to the shareholder. You mentioned earlier there's been a change in the contract.
Yes, a fundamental shift.
For years, the deal was, we are a mature company, we make a lot of money, we will pay you back via buybacks, we are a value stock.
Right. The pitch was, we're safe, we're steady, we're returning cash to you.
And now, with the buybacks at zero, the deal seems to be, we are a growth stock again. We are taking all your money, and we are betting it all on the future of AI.
Trust us. That is the new deal. It is a pivot right back to 2012-era Facebook. They're acting like a startup again, taking huge risks for a huge potential payoff.
But a startup with a $2 trillion market cap? That is a heavy ship to turn so quickly.
It is, and it requires immense conviction from investors. If you are a conservative, value-oriented investor who wants a steady dividend or buyback yield, this earnings report is actually a sell signal for you.
Because the cash return faucet just got turned off.
Turned off and welded shut for the foreseeable future.
So where is this ship heading? What did management say about the future? Slide 5. The road ahead management's outlook and key takeaways.
We have to look at the guidance they gave and also read between the lines. We saw the analyst sentiment in slide 1. They used the word telegraphed.
Meaning management had warned everyone that spending was going to go up.
Yes. They didn't surprise anyone with the spending, but in this report, they doubled down. They explicitly signaled higher than anticipated 2026 CapEx.
Higher than anticipated. It's already astronomical. How much more can they possibly spend on this stuff?
As much as the power grid allows them to. Seriously. Their main constraint right now is not money. It's getting access to enough electricity to run these massive AI training clusters. They're saying, we are going to build the largest computer clusters in human history, and we don't care what it costs.
It's the superintelligence arms race. They are afraid that if Google or OpenAI or someone else gets there first, Facebook and Instagram become irrelevant. MySpace.
Fear is a powerful motivator,
Yeah.
and so is ambition. Zuckerberg genuinely believes this is the next platform, and he is not going to miss it.
So let's wrap this all up with 3 clear takeaways for the listener. They've heard all the numbers, the paradoxes, the spending. What are the 3 things they should remember from this quarter?
Okay, takeaway number 1, top-line strength. You cannot ignore the 24% revenue growth. The ad business, the machine that prints the money, is invincible right now. As long as it keeps growing at this pace, Mark Zuckerberg can afford to make some very expensive mistakes. It is a massive safety buffer.
Okay. The engine is strong, even if it uses a lot of premium fuel. What's number 2?
Takeaway number 2, the cost of business has changed. The cost structure has fundamentally and perhaps permanently changed. Negative operating leverage is the new normal. Don't expect those 48% margins to come back anytime soon. We are in the 40% and maybe soon the 30-something% margin era for a while.
The beautiful high-margin software dream is over. It's an industrial-scale operation now.
Exactly. And takeaway number 3, the AI pivot is real. It is not just marketing fluff or a buzzword for an earnings call. It is costing them billions in real dollars. It is eroding their core profit margins, and it has caused them to completely halt share buybacks. It is the single biggest factor driving the company and the stock.
It's the bet the company moment.
It absolutely is.
Now, before we sign off, I want to leave a listener with a provocative thought, a final destination kind of question to chew on.
Go for it.
We talked about the profit paradox. We talked about how the AI costs are being allocated back to Instagram and Facebook, dragging down their profits despite record revenues.
The AI tax.
Right. So here is my nightmare scenario for an investor. What happens if the AI never makes money directly?
I elaborate on that.
What if we never pay for a Meta AI subscription? What if advertisers don't really pay a huge premium for AI-generated ads? What if all this AI spending, all these data centers, just becomes the new higher cost of doing business to keep people scrolling?
I see where you're going.
Think about electricity, or water, or roads. Utility companies spend billions on infrastructure, the pipes. But they can't charge a huge premium for the electricity that flows through them. It's a commodity. Margins are low and regulated. Is Meta building the pipes of the 21st century where the costs are astronomical and the profits are? Well, boring and utility-like.
That is the utility trap. That is the ultimate bear case. If the cost of compute stays high and AI just becomes a commodity feature that everyone expects for free in their social feed, then yes, Meta slowly transforms into a utility, a very important, very expensive utility with low margins.
And if that happens, the stock is vastly overpriced right now. It's not priced like a utility.
Not at all. But the flip side of that coin is the bull case.
Which is?
That this isn't a utility, that this is the invention of the steam engine, or the internet itself, that if they are the first to achieve superintelligence, or AGI, the value they create will be so immense, trillions and trillions of dollars of new economic value, that these current costs will look like a rounding error in hindsight.
So you're either buying a utility company at a tech premium, or you're buying a lottery ticket for the invention of godlike intelligence.
Chuckles. Those are the stakes. There is very little middle ground right now, and you have to trust the captain of the ship to steer you to the right one.
And considering the captain just spent the GDP of the Bahamas on R&D in 3 months, he's certainly steering the ship fast.
He has the throttle wide open, and he's heading into uncharted waters.
Well, that is a lot to process. From one big, beautiful bill to the future of superintelligence, my head is spinning a little bit.
It's a true deep dive. A lot of moving parts this quarter.
Before we go, we have to do the legal dance. A quick reminder, this deep dive is for informational purposes only. It is not financial, investment, legal, or tax advice. We are not recommending you buy, sell, or hold any securities. Please do your own research and consult a pro. Also, full disclosure, this report was generated by an artificial intelligence model using official company data and real-time search.
Always double-check the data. Don't trust the robot blindly. Verify.
And speaking of data, if you want to do this kind of analysis yourself, but you don't have 40 hours a week to read 10K filings, we have a solution for you. Want institutional-grade stock research without the institutional price tag? Check out stockanalytics.ai.
For just $10 a month, you get full access to our deep dive video library covering over 500 S&P 500 and NASDAQ 100 stocks each, with full source citations you can verify.
Can't find the stock you're looking for? Request analysis on ANY ticker and we'll deliver it within 24 hours.
Upgrade to Pro for $20 a month and unlock our SEC Risk Scanner, which detects red flags in company filings before they hit the headlines, plus our Portfolio Diversification Analyzer to optimize your holdings.
Start your 7-day free trial today at stockanalytics.ai. Make smarter investment decisions with research you can trust.